Fed Chair Powell this week said he didn't yet know exactly what went wrong with Silicon Valley Bank, but that Vice Chair Barr was conducting an investigation to find out. We convened our own expert roundtable to discuss what we know at this point, what we don't know, and what changes should be on the table to make sure we don't repeat what we saw over the last 2 weeks. Here's former Treasury Secretary Larry Summers, former Fed board member Jan Tarullo, and Stephanie Flanders, Bloomberg Executive Editor for Economics and Government.
I trust that the largest banks truly are in the much better capital and liquidity position that Jay Powell referred to yesterday during the press conference. We know first that there was a significant supervisory failure somewhere along the way. Was that failure in the San Francisco Fed's inability to identify problems of growth and maturity mismatches and the like early on? Was it the failure of the second San Francisco Fed team which did identify some problems, to follow up in a sufficiently robust way? Was it a supervisory failure because of the light touch approach to supervision that the Federal Reserve Board had put in place over the last 4 or 5 years? But I think in the most immediate sense, this is clearly a supervisory failure. Other factors may be uncovered as the Fed's own investigation proceeds.
Larry, let's put you back at the Treasury, or for that matter, at the White House. If you were looking at this situation, what questions would you be asking to make sure you understood the possible ramifications of what we've seen so far in a broader financial context?
Before I answer that hypothetical, let me put a question to my friend Dan. Dan, I've heard it said, and I don't know, that even in 2022, the Fed stress tests that were applied to the largest banks did not include an analysis of the stress from a major interest rate hike. If that's true, that seems kind of bizarre from the point of view of the world of early 2022, when certainly many people, certainly me on David's show, were emphasizing that there was likely to need to be very substantial increases in interest rates. Can you say something? And if the stress tests weren't considering increases in interest rates, then perhaps the exempting of Silicon Valley Bank from the stress tests was not central to understanding the problem. Can you say something about interest rate hikes and Fed stress tests?
Sure. So first off, I think, Larry, I agree with the statement you made toward the end of your question, which is, if Silicon Valley had been in last year's stress test for real rather than its stress rehearsal, I don't think it would have made much difference, for precisely the reason you say, that they weren't stressing the things that were the SVB vulnerabilities. With respect to stress testing generally, over the last 5 or 6 years, the stress test has become eminently predictable, but it follows the basic pattern of the scenario that was developed when we began doing the annual stress test. The scenario, of course, includes a reduction in interest rates because of the hypothesis of a recession and the Fed's reaction. So to some degree, the answer to your question is, like supervision generally, the stress test has become less rigorous over time. And I think, more importantly, it's become too predictable. And the whole purpose of a stress test is that you're trying to stress against the unanticipated, not the anticipated.
Stephanie, you've worked at the Treasury
Sure.
of the United States. You also have covered financial markets and other business issues over in Europe for a good long time. One thing we're hearing from both Larry and Dan is rates were going up, and they weren't just going up here, they're going up over in Europe as well. Was what we're seeing right now in the banking system, maybe not the specifics of Silicon Valley Bank, but was something like that almost inevitable? After we pumped so much money into the system and start taking it out, there's going to be stress, real stress, and there's going to be some failure.
I think in this conversation, I think it is important when we're thinking about what the implications are, you have to distinguish what is an outlier about not just Silicon Valley Bank, but others that have got into trouble in this episode. What is fundamentally a regulatory stupidity, a very traditional problem, the interest rate risk that was just hiding in plain sight, and what is a genuinely new issue, which was not being fully taken into account by anyone looking at the risks. And I think when you look at something like Silicon Valley Bank, clearly it was an outlier in the speed with which deposits had been built up, in its massive exposure to uninsured deposits and reliance on that for funding. I hope it was an outlier in not having a chief risk officer for 9 months, which was an extraordinary state of affairs. What was very traditional about this, and as the discussion with Larry and Dan is suggesting, was that right here was a massive interest rate risk that was, whether or not it was in the stress test, was something that central banks should have been thinking very hard about. And I think it was sort of striking that we had a lot of the debate around this. What are the hidden risks? All the conversations that you will have had, David, when you ask regulators what's keeping you up at night, they would always talk about private equity. They'd talk about non-bank shadow banking has been the thing that people were, was this worry for all these years. And in fact, it was the most obvious problem sitting on bank balance sheets as a direct result of monetary policy actions by central banks that has actually caused this issue. I would just say, though, one of the reasons maybe they weren't looking at that so closely, although I'd be interested to know what Dan and Larry think about this, there is an element of this which is new, and we see in the speed with which deposits left these institutions, and that's the non-stickiness of those deposits. And I think one of the things that regulators were thinking when they considered interest rate risk potentially was that there was a sort of self-hedging mechanism in a bank of the fact that deposits would be slow to move if they weren't being paid the higher interest rates. That is no longer the case, and I think that probably does have longer-term implications for regulation and potentially longer-term implications for how much we insure deposits.
Yeah, I think that was a question for either Larry or Dan. Does our entire approach to deposits change given what we've seen? The fact is they're not as sticky as we thought they were.
That's what I was alluding to earlier. I'd like to have a sense of exactly what the deposit profiles of this group of banks is as a whole, because in theory, at least, the supervisor should already have been distinguishing among different kinds of uninsured deposits, some of which have always been understood to be eminently runnable, others of which have were thought to be at least somewhat stickier than insured retail deposits. Right. If it turns out that those, and this is what Stephanie, I think, was suggesting, that those middle categories have changed, then we're going to need a change in regulation and not just in supervision.